A very good morning or good afternoon to you, Mr. Anthony. My name is Ian. So today I'm going to do a presentation on the basics of fundamental analysis in a company level. Often people will compare with other company, but it's still best to understand the company that you wish to invest before you move on to compare. So today I'm going to show you how to analyze just the company itself. So the company I'm presenting on is Jardine Cycle & Carriage. Before I begin, let me just start with an overview of fundamental analysis. So fundamental analysis. So what is this? So in general, people will be like thinking, I got no clue what is fundamental analysis. Oh no. So let me just explain like what is roughly about for fundamental analysis. So the main purpose for fundamental analysis is to understand the future prospect of the business, understanding the financial health, and analyzing the financial report. So what's the reason for this? The reason is to understand the value of the company, the pricing in the stock market, and as well as stock market may price a company inaccurately from time to time. So fundamental analysis comprises of two parts. Firstly, quantitative and qualitative. So let me just zoom into what is quantitative. It involves looking at numerical values like revenue, expenses, assets, liability, where we'll talk about more for the financial ratios later on. So next will be qualitative. I will do a SWOT analysis on this: strength, weakness, opportunities, and threat. So let me just start with an overview of the company that I'm doing, Jardine Cycle & Carriage. They're in the automotive industry. I renamed from Cycle & Carriage following the integration into Jardine Matheson Group in 2004. Founded in 1899, have over 100 years of operating history. They sell Mercedes-Benz, Mitsubishi, Kia Motor, and Citroën. Services involve retail, distribution, and provision of after-sales services. So now let's begin with the quantitative analysis of Jardine Cycle & Carriage. Let's zoom. So the first ratio that I'm going to talk about is liquidity. Of course, there's four ratios where I'll be talking more later on. So for liquidity ratio, I'll start with current ratio. N is derived from the formula current ratio equal to current assets over current liabilities. So based on the graph, you can see that current ratio has been decreasing and then going up again. But from 2012 to 2013, there's quite a huge decrease as you compare between 2009 to 2012, the differences. Yep. So let me give an explanation on this. Maybe the words is too small, so I did a zoom. A current ratio of 1.24 equals to, for every $1 owned by the firm, it has $1.24 of cash that can be converted into cash to meet that obligation. So there's a lot of critics that saying that liquidity ratio, current ratio is not a very good indicator. So we have a CRIP ratio, which is CRIP ratio equal to current assets minus inventory over current liabilities, which is a better indicator because it really measures the ability of the company to pay all current liabilities if it comes due immediately. Alright, based on the graph, you can see that CRIP ratio of 1 equals each dollar of short-term debt is backed by $1 of cash or near assets or company. So if based on this, you can see that if let's say it's 1, right? So if let's say they have any short-term debt they need to back, they have $1 of cash or near assets. So but then it will, if something like this were to happen, right, it will be exhausting for the cash. And a higher CRIP ratio will be more desirable. So moving on, now talk about efficiency ratio. So for efficiency ratios, there's account receivable turnover ratio and inventory turnover ratio. Receivable turnover ratio is credit sales over account receivable slash debtors, and then it highlights the company ability of collecting cash from creditor. A ratio of 4.14 times, as you can see as at 2014, equals to average account receivable collected 4.14 times. So equals to 88 days. If you take 365 divided by 4.14, you can give it a try. If decreased further, may face cash shortage problem and higher risk of bad debts. So next will be inventory turnover ratio. This ratio actually highlights the measurement of the number of times that operating income can cover interest expense. So let's zoom in. So this is the graph, and then you can see that from 2009, right, and then there's a gradually decrease, and then from 2011 to 2013 is also decreasing. So a ratio of 10.55 times is equals to, on average, company is able to sell its inventory at 10.55 times. Relatively ease in selling, takes 35 days to sell its inventory. We take 365 divided by the turnover ratio again. So if let's say this were to decrease, right, it's difficult to sell. It means that you have difficulty in selling, so it will be risky. Why? Inventory is tied up, can't translate revenue or profit. So if you base on this, right, maybe it's not a good choice because to invest, because it's like gradually decreasing and it may still be decreasing. So the next ratio that I'm going to talk about is leverage ratio. So the first one, debt to equity ratio, total liabilities over shareholder equity. So this is the graph. So wondering equity debt, so what does this mean? So 2009 to 2012, let me just do analysis. Increase in ratio 2009 to 2012. In 2013, decreased to 0.54. So what does this mean? A ratio of 0.54 is equal to 54% of shareholders' equity is financed by borrowing. Every $1 of shareholders' equity equals to 0.54 cents is financed by borrowing. Higher the ratio, the riskier it is for the company to go into default. And why? Because more than 50% is being financed. So it's deemed to be not satisfactory if let's say it's more than 50%. Higher risk of being default. So the next ratio I'm going to talk about is interest coverage ratio. So interest coverage ratio you can see from the graph here. And then this right. So ratio decreasing since 2010. As at 2013 equals to 10.15 times, sorry. Ratio of 24.15 times, right, equals to recurring income is 24.15 times of interest payment. So there's a relatively high ratio here which shows that they have the financial strength. So if they were to pay their interest payment, they won't exhaust much income. However, it is still decreasing. So I will just skip and move to profitability ratio. So for profitability ratio, right, I'll start with net profit margin. So net profit margin is derived from net income divided by net sales. You can see from the graph here. From 2010 to 2013 it has been decreasing, and the ratio as at 2013 is 4.6%, which is the lowest. Which means, what does this really mean? Every $1 net sales generate is 0.46 net profit margin. So higher the profit margin means higher net sales dollar are providing profit to business, and fewer net sales dollar are absorbed by expenses. But for this case, right, more net sales dollar are absorbed by expenses. So this may not be a good investment choice if you're based on this. So next that I'm going to talk about is return on assets. So return on assets is derived from net income over total assets. So based on this graph, right, you can also see that from 2010 to 2013 it has been gradually decreasing. So a ratio of 4.6% actually indicates that for every $1 asset it generates 46 cents. Decrease could be due to inefficient and ineffective use of assets. Equal ratio will decline and less profit generated. Moving on, I'll talk about return on equity, which is net income divided by shareholder equity. So based on the graph, again you can see that gradually decreasing ratio from 2010 to 2013. As at 2013 ratio is at 20.6. So what does this mean? Ratio of 20.6 equals to every $1 that ordinary shareholder had invested equal a net profit of 0.26 cents. Decrease could be due to company ineffectiveness in usage of funds received from shareholder. However, 15 to 20% is counted satisfactory for returns on equity and deemed to be attractive. So they are still okay at an acceptable level. So the next ratio that I'm going to talk about is earning per share. Wow, this is important because net income divided by total outstanding shares. Based on the graph, you can see that from 2011 to 2013 there's decreasing ratio. As at 2013 its earning per share is $3.22. So which means that every share of common stock generates earning of $3.22 net income. So for earning per share, right, there's no rule of thumb. What's the interpretation? Is it good or what? Of course, it's the higher the better. So company earning per share, you can see that it's at the range 3.64, 3.62, 3.47. It's at the $3 plus range. So I would say that it's stable and it's a reliable company for investment. Next will be price earning ratio. So price earning ratio is a good indicator of company prospect. So from 2012 to 2013, right, there's a sudden drop in PE ratio. As at 2013, PE ratio is 11.1. A ratio of 11.1 equals to investor is willing to pay $11.10 for each dollar of earning. Higher PE ratio equals investor willing to pay more. But however, here 11.1 as at 2013, so PE ratio declined. Investor perceived future value will decline. So if you base on this, it may not be a good choice for investment. Alright, now I'm going into qualitative analysis now. So as I said, I'll be doing a SWOT analysis for this. So the first one I'm going to talk about is the strength. So the strength of Jardine Cycle and Carriage should be they have a very experienced leader, Mr. David Alexander Newsbegin. And why do I say so? Since April 2012, Mr. David has been also known as Alex, has been appointed as Chief Executive Officer and Group Managing Director at Jardine Cycle and Carriage Limited. He have wide range of experience. He also is the CEO of the IKEA, and then he has been with Jardine Matheson since 1995 and had taken part in variety of roles. So with such an experienced leader, he's definitely be able to lead well for Jardine Cycle and Carriage. So next will be diversified business operation. Okay, for Jardine Cycle and Carriage, right, they engage in motor vehicle retail, distribution, as well as after sales service for Mercedes-Benz, Mitsubishi, Kia Motor, and Citroën. So they have a very diversified business operation. Sorry for my tongue tied. So, and they also have a good brand name. They distribute Mercedes-Benz and they have the distribution right. So when people hear about Mercedes-Benz, they will be like, whoa, Mercedes. So they have a very good brand name there because Jardine Cycle and Carriage has the distribution right of Mercedes-Benz. And then proven financial strength. Why do I say so? They have been operating for like over 100 of years in Singapore since 1899. So what does this tell you? They have gone through economic cycle and 2 world war and they are still surviving. So what does this mean? They have good financial strength. And then the next one will be they are also a leading Singapore listed company, which definitely show their strength. But you can see the apps right here, they are strong. So next, I'll talk about the weakness. Alright, I would say that they have a weak financial planning. As you can see, their declining liquidity ratio, right? It could really cause them much harm if they continuously be like this, and could maybe be in a risk that they cannot even pay their debts because the crib ratio is at 1. So they are just right there to pay the debt if it will come due short immediately. Next will be weak generation of profit. Majority of earning, right, is contributed from Astra International because Jardine Cycle and Carriage, right, they own 50.1% of Astra International. And they're also in the automotive industry. So if let's say any mishap were to happen, right, to Astra International, right, it could really affect severely for Jardine Cycle and Carriage. So I think that they should really do something about this. Alright, talking about weakness, right, so now I just don't talk about the bad things so long. I'll talk about their opportunities based on Nielsen Global Survey of Automotive Demand. August 14 and September 6, 2013, there's a rising demand for automotive, as in using of cars. So there's a huge potential in Indonesia and Malaysia, and guess what? Jardine Cycle Carriage Limited targets their business in Southeast Asia, which with business operating in Singapore, Malaysia, Myanmar, Indonesia, and Vietnam. So wow, it covers Indonesia and Malaysia too. Hence, it will have a great prospect for Jardine Cycle Carriage in the upcoming years. Why? 46% Indonesian household has no car, and they have an expanding middle class. And 54% of Malaysian owns multiple cars, and they have boosted the third highest level of car ownership globally, 93%. So the last part that I'm going to talk about is trade. And I would say that it's legal regulation. For example, if the government impose law on like the usage of car or any increase in tax, it could really affect the car sales. So I'll take Singapore for example. CO increase, car sale decrease. So what does this happen to Jardine Cycle and Carriage? Of course, it will be badly affected because they distribute cars and they also take part in selling of cars, and so this could really affect their sales by a lot. So all in all, I would say that it's safe to invest based in an overall view of qualitative analysis, as they have been operating so many years and they have so many upcoming opportunities in Indonesia and Malaysia. Alright, I hope you enjoy my presentation and understand the basics of fundamental analysis on a company level. Though it's a bit dry, but I try to make it as interesting as possible. Check out the background music. Alright, before I end, I would like to say thank you for watching the whole video and have a nice day. You're awesome. Thank you.